Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Okay, I thought I might take a few questions today that we received, and the first question is from Gage in Middletown, Delaware. Gage says, I'm getting ready to start my first job, and my boss gave me a W-4 form to complete. I don't really understand it. Would you please let me know how to fill it out? Well, Gage, that's a great question. That's a question we get a lot. So let's talk a little bit about the W-4 form. Is basically the form that the IRS asks your employer to complete to figure out how much to deduct from your paychecks. So the first place you want to start with that is deciding if you're exempt or not. Now, what do I mean by exempt? Well, generally, if you make less than $10,350 per year, you're not going to have any federal tax obligation, so you can mark the form that you're being exempt. Now, where you need to be careful about this, Gage, is if you're still being claimed by your parents. In that case, if you're going to make more than $6,300, you're going to want to make sure you claim an adequate deduction. The first place to start on the form, actually, is to go ahead and fill out the worksheet where you decide on the allowances. And I get this question a lot. An allowance doesn't necessarily mean that you have children. In other words, the more allowances you allow, the less deductions are going to be taken from your check. And vice versa, the less allowances you have, the more that's going to be taken from your check. So you really have to take a look and decide how much you want to put aside in taxes, and that's the way you'll base your allowances decision. And then it's really simple. Just go ahead and fill out the form. Generally, your employer is going to give you the form. If you don't get the form from your employer, then you can go ahead and get one from irs.gov, or you can download it directly on the Ask Ralph app. Our next question, this is from Heather in Dover, Delaware. And Heather says, my husband and I are having some financial troubles, and we're thinking about taking some money out of our 401k plan. But I've heard that this may not be the best idea. What are your thoughts? Well, Heather, this is a great question that you've asked, and it's a question that is really a complicated question, and it's a question that a lot of people make a mistake on. I get a lot of calls in my practice about this very issue. Unfortunately, most of the time, I get the call after it's already been done. What you need to consider is that the immediate cost of cashing out the 401k can be very expensive. I generally tell clients, you're going to lose half of your money up front. And why is that? Well, you're going to pay federal, state, as well as a 10% penalty for taking your money out before reaching age 59 and a half. Fidelity did a study not too long ago, and it shows that 1 in 3 people who are covered by 401k plans have actually taken the money out. Now, there are some better ways to do this, one of which would be what's called a hardship withdrawal. And you can look into the IRS and find out more about the hardship withdrawals, and we may talk about that in a future broadcast. But generally, that eliminates that 10% penalty. Another great option, actually, if your plan allows it, is taking a loan from the 401k. Now, this you need to be careful with as well. The reason you need to be careful there is that if you take a loan against your 401k and you later lose your job or quit your job, then that 401k loan will become a distribution when you lose your job. Now, the final thing to consider, though, and this is important as well, is if you take that money out of your 401k plan, you're going to lose the benefits of that money growing over time. So all of your plans about, putting away for retirement are going to be lost if you take that money out of your plan prior to 59 and a half. So if you're going to consider this, I would definitely recommend you speak to an advisor, and that person can give you an idea as to the real cost of doing this withdrawal. Our next question comes from Ryan in Newark, Delaware. And Ryan said, this is my first year filing my taxes, and I'm wondering what documents I need to set aside in order to prepare my taxes. I don't want to miss anything, so please let me know what to save. Well, thank you, Ryan. I appreciate this question. I really break this down into 4 areas. The first area is going to be your personal data. You're going to want to have a copy of your return from a previous year. Now, if you haven't filed, then you may want to ask your parents for a copy of the return they filed on your behalf. You're going to need your Social Security number. And if you're married, you're going to need the Social Security number of your spouse and any children or parents that you may be claiming on your return. The next area is your income data. Generally, most of us get a W-2 form. but it could be something like a 1099 form you got from the bank or a 1099 form that you got from an investment company. You also want to take a look and make sure you set aside any earnings you receive from unemployment benefits. A lot of my clients forget about that, as well as lottery winnings. And that's one that a lot of times we'll forget as well. The next area of concentration would be deductions. What am I talking about there? I'm talking about any retirement contributions you've made. Now, if you made them through your W-2, they'll be right on the W-2 like a 401k plan. But if you put money into an IRA or something like that, you want to keep track of that. You want to keep track of any educational expenses, medical bills. If you're a homeowner, you want to keep track of property taxes and mortgage interest. Also, any mortgage insurance that you've paid. You definitely want to keep records of your charitable contributions. If you're a school teacher, you're going to want to keep track of any classroom expenses, as well as, for everyone, any taxes, local, state taxes. If you don't live in Delaware and there's a state that has a personal property tax, you're going to want to keep track of that as well. And in the final area, of course, is any taxes that you've paid throughout the year. Now, most of those you're going to see on your W-2 form, but if you've made any estimated tax payments, you're going to need to record those as well when you go to file your taxes. Our final question is from Brooke in Orlando, Florida. And Brooke writes, I just bought a home this year, and I heard that this will help me get a big refund. What other deductions would I be able to take now that I'm a homeowner? Now, Brooke, I will tell you in my practice, this seems to be the thing that generally brings new clients in. So this is a great question you have here. The first thing we need to talk about is standard versus itemized deductions. So depending upon when you bought your house, you may not have that big of a bang in the first year. So we'll have to take a look at that. We also want to look at charitable contributions, both in cash or in any material things that you've given to the Goodwill or Salvation Army. We're going to want to look at medical and dental expenses. Now, this one is difficult because there is a 10% of income limitation for most people. So you have to have a lot of medical expenses in order for this to work. Specifically, what you asked about was home ownership. So what are the things that we'll look for there? We're going to look at interest paid. We're going to look at mortgage interest, mortgage insurance. You're going to get a 1098 from your mortgage company that shows that information. Also, your property taxes. A lot of times we'll see a new client because they've bought a new property. So you definitely want to share your settlement sheet with your accountant or tax preparer. There are items there that you can deduct. We also want to look at education expenses. We look at tuitions, books, supplies, lab fees, and other travel and transportation. And actually the final area, and this is an area where I get a lot of questions as well, and that's unreimbursed employee expenses, such as mileage for using your own vehicle or tools or insurance or supplies that you have to buy on your own. Now, again, this is an area that's a little problematic because there's a 2% of income limitation. So in other words, you can't take any deductions for these until you've reached over 2% of your income. So these are great questions, and I look forward to you sending more questions to us at AskRalph@AskRalphMedia.com.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.